Let's go.
Welcome, everyone, to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. This is Ryan Nauman, the market strategist here at Zephyr. It's been a very interesting first 6 months of the year. The S&P 500 is having a decent year. Tech is booming again. Tariffs, they're still here, still capturing headlines, but never really seemed to be a long-term issue. At least the markets didn't think that after recovering after Liberation Day. Earnings are growing, economy seems okay, and the Fed is staying pat. Despite the noise, financial markets, whether it's fixed income or equities, have had a solid year so far. Well, I have on the perfect guest to talk all things fixed income and what it all means for financial advisors as they build investment portfolios for their clients. But first, this episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions. All right, let's go ahead and get started and bring on the star of the show. Enough from me. I'd like to give a very warm welcome to Robert Cohen. Robert is the Director of Global Developed Credit at DoubleLine. Robert, thank you so much for coming on the show. It's an honor to have you on. I'm very excited about this conversation. It's going to be a good one. Can you please tell us a little bit more about yourself and DoubleLine?
Yeah, I'll start with myself. So I run the corporate credit group at DoubleLine. So that includes all of our investment activity in investment grade credit, below investment grade credit in terms of high yield, and in the bank loan market, another area of below investment grade. DoubleLine is a fixed income specialist. So we invest across all fixed income, treasuries, corporate credit, securitized credit, emerging markets, and other areas. So we try to be a one-stop shop for someone who's looking for any kind of need in the fixed income market.
Fantastic. Yeah, I've been following DoubleLine and all your thought leaders. You guys produce some great content. Your products are fantastic. So great job there, Robert. So let's just start at the top and talk about the major macro themes that, investors must contend with. Because like I said, there's a lot of noise out there, but markets have been resilient. Can you please provide us with, your views on the current macro environment?
Yeah, well, I guess we have to start with, tariffs have been disruptive, so that's everyone's talking about it. Tariffs create uncertainty about inflation and about growth. There really has been uncertainty about that for some time, really since 2022, when
Yeah.
inflation really reared its ugly head, and we had rate market respond to that, and equity markets respond to rising rates and the Fed raising rates to combat inflation. And then we've had volatility really since then in terms of Treasury volatility. We've had above average Treasury volatility. And then we've had, up until recently, high equity market and credit spread volatility. That has calmed down this year. But the Treasury volatility remains because the outlook for inflation is uncertain. We have headwinds from, of course, tariffs. We also have headwinds from the fiscal situation, the large national debt and deficit, and what that means for treasury rates. People have had it's been unclear what growth in the U.S. is going to be and what that means in terms of corporate earnings and where the stock market should be. I think I'd back up a little bit. For really since 2022, people have been calling for a recession. That year, 23, there's going to be a recession. 24, there's going to be a recession. 25, there's going to be a recession. The inputs into that call have changed over the last few years, but I think what I would say is that really after the pandemic, a lot of the macro indicators that have been very good signals of either economic growth or weakness have really been kind of disrupted. They've gone almost haywire because of all of the effects of the pandemic and then inflation and then the disinflation. What has worked better to some extent, I'm a corporate guy, so I look at earnings. Earnings have been, I think, a better indication of maybe short term what's going to happen over the next 6 months, because that's, I like to say, closer to the ground. Companies producing a good or service, selling it, getting the response from their customers. That's a little bit closer to, real economic activity as opposed to yield curves, commodity prices, other things that tend to historically been very good indicators of where the whole economy is going, but haven't worked lately. And so here in 2025, I'm sticking with the I don't see a recession. I didn't think there was in prior years either. I know there's kind of clouds on the horizon, but if I look at, what earnings are doing so far, they're still pretty resilient.
Yeah.
The areas that are impacted by high rates or tariffs or other pressures are certainly feeling the pressure. But if you look at the economy as a whole, things look pretty good.
Yeah. Yeah, that's a great point. I was going to bring up about I'm glad you said the yield curve as an indicator of a recession. And you brought up 2022, yield curve was inverted. Everyone thought, well, there we go, recession's on the horizon. This might be the first time, and according to all the talking heads out there, first time ever that the yield curve didn't indicate a recession was coming up soon. So glad you brought that up. And you brought up earnings, right? Do you think in tariffs, we all know that the US economy is now really shifted to a services economy. I think what 60-70% of the economy is now made up of earnings from services. Does that help the US economy kind of weather this tariff storm? It's hard to apply tariffs on a service. Does that help, the
Yeah,
earnings and the
I think that's been helping, even if you kind of go back up before we were talking a lot about tariffs. So the answer is yes, but it also helps in other areas too. We were worried about what higher rates meant, and higher rates hit certain industries. They hit housing, they hit autos, durable goods, but they don't hit everything. I think the fact that we have more service related economy has maybe muted the effect of higher rates. And I think maybe that will mute the effect of tariffs because we have such a service-related economy. Now, with an asterisk, because there are big industries that can cause a lot of stress in the economy, really autos in particular,
okay.
depending on where we land in terms of auto tariffs. That's a pretty significant part of the economy. And if that doesn't get sorted out, that could be a drag. But more broadly, yes, I think that because we have so much in terms of we have a high percentage of services. I think that is to some extent muting the effect.
Yeah. Well, that was a good call on your part about no recession in 2025 and even earlier. So good call there. You know, let's talk about, credit spreads. You brought it up, corporate credit spreads. They've narrowed, after Liberation Day, they spiked, there's concerns about the tariffs. Well, those spreads have really narrowed since then and kind of in a range. And
Yeah.
um, do you agree that current spread levels don't seem to indicate bond markets believe there's much distress ahead? Because right now at levels, it's like bond markets kind of like, well, ho hum, we're okay.
I think it's a combination of a couple things. It is clearly a sense that the economy is doing well. That gets you to some level of spread tightening. I think that it's gone beyond maybe what would be indicated by the economic outlook because of the supply dynamic. Capital markets in corporate credit have been very busy, but it's been mostly a refi market. There hasn't been, even if I zoom out beyond corporate credit, there hasn't been much credit creation over the last few years. Typically, in an economy that's growing, credit creation is a driver of economic growth. We haven't had that. And so, whether it's new mortgages, people aren't borrowing a lot to buy new homes, companies aren't borrowing much to expand their business. You can expand that to the whole economy. There isn't much credit creation. So, specific to corporate credit, I think there has been a lack of supply given all the demand for credit given higher yields. And I think that's pushing it a little bit further than it would normally be because there just isn't enough issuance to feed the demand. So credit spreads are pretty tight.
Yeah.
Um, I think by itself, that would be something that would be concerning. But if you look at other areas like the equity market's pretty rich too. I
Yeah.
think a theme that I've been talking about really since last year, and it continues into now, is if you look at, take the S&P 500 trading at about a historical multiple of about 25, that's a 4% earnings yield. So the 10-year treasury today was, I don't know, 4.4, something like that.
Yeah.
That's actually a negative risk premium relative to the 10-year. So PEs aren't everything, but there's something to look at. So you're not getting a whole lot in terms of risk premium relative to fixed income. If you look back, really, before 2022, for most of the last 10 years, we've had such suppression in treasury yields that even a high multiple on the S&P was still better. So even if the S&P traded at maybe 20, a 2021 multiple, closer to a 5% earnings yield, compared to a 2% treasury, you still had a pretty significant risk premium. So credit spreads are tight, but compared to the equity markets, they don't look that bad.
Yeah.
And fixed income broadly is pretty competitive with equity markets at these valuation levels. And I think that's an important thing to point out.
Yeah, very, very interesting, Robert. Thank you. It's fantastic. So, do you think then at these spread levels, and you talked about risk premium maybe isn't there right now, do you think investors are being rewarded for taking on credit risk at these levels?
Uh, it depends where. So I think our view is that our firm has a view of being up in quality. And so spreads are tight, whether you're up in quality or down in quality. The credit curve is flat, meaning to go from a triple A to a single A to a triple B to a single B. There's not much in terms of a pickup in spread. So when you find that, I think the right thing to do is to go up in quality because you're not getting much to take additional credit risk. And if you just think from a high level, credit does well broadly in a slow growth economy. So if you think the economy is going to grow, if you're going to have above trend growth, well, that's fine for credit. But even if you have positive but below trend growth, let's say 1%,
Yeah.
most credit can do well. Let's say double B on up to triple A. Where you get into trouble in a slow growth environment is single B, triple C. That's really more of the high yield and bank loan market.
Yeah.
The lower parts of securitized, the last tranche of securitized markets, because those companies need growth to service their debt. So I don't know that it's a great time to be piling into triple C credit
Yeah.
because the growth and rate outlook is uncertain. But you take a triple B investment grade credit, those companies can do well even if growth is slow. So the up in credit trade I think still works. Yes, it's true that credit spreads are tight. It really depends what you're comparing it to. Um, I think versus equities, credit is quite attractive even with the tight spreads because both markets are rich,
Yeah.
but the volatility in credit should be lower. And it's actually possible that you could end the year with equity markets and credit markets delivering the same type of returns.
Yeah.
That's what I've thought last year. I think it's possible this year. The S&P was trailing high yield up until recently.
Yeah.
Now, I don't know, high yield's up about 4.5% year to date. The S&P is up maybe 6.5. So it's outperformed a bit. But you can end the year with them both in mid-single digit total returns. Volatility adjusted, you're better off in high yield. So it really depends, like credit versus what else. I think versus equities for sure. Is now the time to sell your T-bills and buy corporate credit? I'm not so sure about that. I think maybe that type of risking up is not the time. But like I said, the overall view of the firm is we think that's appropriate to be up in quality, look for safety. You can buy corporate credit and other areas of credit where there's a margin of safety in case the economy slows or there's a shock. We also have been shorter in duration. So we can talk about interest rate duration, but we also being short in duration in credit means short spread duration.
Okay.
So shorter corporate bonds and bonds that don't have have some call protection. Uh,
Mhm.
give you a little bit of a downside protection if spreads widen too. So we like that as a tool to manage risk. So being shorter and being up in quality.
Yeah, Robert, a lot there to unpack. That's fantastic. Let's go back what you mentioned about, the issuance. There's not a lot of new issuances out there, and that's a really interesting take. I haven't heard that much in a lot of conversations I've had regarding fixed income. Do you think that's number one, higher interest rates? It's interesting. We say higher interest rates, but really they're normal.
Yeah.
Historically, they're kind of in normal range. But is it because maybe corporations borrowed so much when interest rates were at 1%, 0%, and that they just don't need that credit any longer?
I think it's a combination. There are certainly larger corporations that borrowed when rates were at all-time historical lows, and so they locked that in. Also, companies that were going to borrow to deploy capital into growth initiatives have really sat on the sidelines, partly because of rates, partly because we have a new administration and we have economic uncertainty. And until that uncertainty unfolds, which I think it is right now, people have been sitting on the sidelines. I think once we have a little bit more clarity on tariffs, I could see, and we have had more stability in rates even though they haven't come down, but we have stability in rates. I think that's an environment where companies that want to borrow money and feel better about the economy might start borrowing again. And I could see that across the board, not just corporates, but maybe people feel like the economy's okay, housing is stabilized. Maybe they want to, they're waiting for lower prices and they've waited long enough, and maybe borrowing across the economy will start to pick up. So that could certainly be the case. An area that drives the below investment grade market is M&A. M&A has also been basically frozen, among other things, because of regulatory concerns.
Yeah.
So now we're in a more laissez-faire regulatory environment. So that is another reason why you can expect M&A to pick up into back half of the year and into 2026. So I would expect M&A and borrowing as a whole across corporate credit to increase substantially, let's just say over the next 12 months.
Yeah, fantastic. You mentioned, slow growth environment, deals well, corporate credit tends to fare well with slow growth. Well, to me, looking forward, kind of seems like, that's a good environment then, because to me, looking forward, slow growth, it's kind of like where we're in now, and I expect it that way moving forward.
Yeah, absolutely. Uh, with inflationary pressures and high rates, it's kind of the base case that you're going to have a slowdown in growth. I think the second quarter assumptions are that the tariffs are because people were apprehensive about what the outlook for tariffs would be, they restrained spending. But then the estimates are that that recovers in in the third and fourth quarter of this year. There's also maybe an option on AI being a productivity gain that will drive a little bit, maybe growth better than people expect.
Yeah.
And I'm not talking about the headline names like Nvidia and Google and
Yeah.
Alphabet and so on. I'm talking about regular companies deploying AI as an efficiency tool, which happened with the internet. So the big gains when the internet and the PC and internet boom happened in the 90s, of course, were all the tech companies, but also regular industrial companies that could deploy technology to be more efficient. So that could be the kind of wild card that generates a surprise upside in growth if this AI revolution really starts to permeate the economy as a whole.
Yeah, fantastic. I know, just in my research and investment research and then the podcast, AI has made me more efficient,
Yeah,
right? In the past a few months. And it's like, wow, why wasn't this around a few years ago? This is fantastic. That's a great take because I can see that happening.
absolutely. Yeah.
Um, I often talk a lot, did some research about diversification and how, things are starting to get back to normal. And we just talked about how about interest rates. They're now normal, 1% interest rate, zero, that's not normal. Things are, inflation's coming down, might be sticky. Tariffs aren't normal necessarily, but has that normalization in macro environment kind of helped your outlook on bonds moving forward? Also, bonds didn't work in 2022 for numerous reasons because interest rates before then were at 1%. But is that normalization going to help corporate credit?
Oh, yeah, absolutely. I think that fixed income as a whole offers a much more attractive proposition than it has during the 10 years or so of yield suppression. So bonds as a whole provide competition now to other asset classes. So you start with just a T-bill at 430 or wherever we are, and a little over 4%. That cash yields something now. And as you move into other, other areas of fixed income, if you focus on if into credit, for example, getting 5+% investment grade,
Yeah.
uh, investment grade credit used to have a much lower yield, let's say 3% or 3-4%, but with the duration of almost 9. So you didn't have much in terms of yield, but you had all this interest rate risk. Well, now corporate credit, investment grade credit yields a little bit more than 5. So you have much more yield, but also the duration is shorter. So the relationship of yield per unit of duration is so much better. So I find that a lot more attractive than it was in the past. If you look at high yield yields 7%. Now we know about spreads. Spreads are tight, but seven, a high single digit type of return in high yield, that's pretty attractive. High yield, the yield on high yield in 2021 was about 4%. So
Mm.
a lot lower. Triple C's were more like 6%. So now the whole index yields more than triple C's yielded in 2021. So kind of the whole yield proposition is so much better than it was
Yeah.
before that it actually acts as a competitive option versus just being long equities because equities are the only thing to own and for
Yeah.
most of the last 10 years.
Yeah, you bring up a good point. For how many years was it Tina? There is no alternative to
Right.
equities. Now all of a sudden there is, whether, maybe in treasuries, because like you said, treasuries are now getting 4.5% potentially, and corporate credit's very attractive. So now is that something that advisors should consider too? Is, like you said, we've had a great run in equities, you know, but now they're getting lofty, valuations are lofty, maybe moving to corporate credit, because it's you're not going very, super conservative, but you're taking some money off the table, yet you still have, locking in 5%.
Absolutely. I think some mix of a corporate credit, uh, depending on, every situation is different, but certainly from taking away from an equity exposure, I think that's kind of a no-brainer. And I think your total return over, let's say, a 12-month time horizon is not going to be that different. That would be my guess. So
Yeah.
you have to ask, what are you giving up? Kind of embedded in this outlook is that the years of having a 25% total return are behind us. So if your outlook is you're going to generate a high single digit return in equities and you're going to generate something similar, maybe mid to high single digit in a mix of different credit portfolios, you're not giving up a whole lot
Yeah.
and you're saving yourself from a potential for a lot of drawdown. So I think that that makes a lot of sense. I think investors have been scarred by 2021, particularly, the rate rise. So people who own long duration assets got pretty hammered.
Yeah.
And so there's been a tentativeness to go into fixed income broadly. But the answer for that is we don't think you should go into very long duration. We like shorter duration and up in quality. And so I think that's the place to be. There's still risk to the long end in our estimation. So our portfolios are shorter than they've been in the past and are up in credit quality. And so I think that's a very good place to be. An area that I think I like the most in fixed income is short duration, high income.
Okay.
So you keep a duration of, I don't know, let's say 4 or lower, maybe 2 to 3 year duration, and a high income portfolio that's throwing off, depending on risk, somewhere between 5.5% and 6%. Uh, I think that's a kind of the sweet spot where you're not taking too much credit risk, you're not taking too much interest rate risk, and a 5 to 6% yielding asset is pretty good. And again, has a chance of being very competitive against equity markets.
Yeah. Robert, that was a fantastic segue. You answered my next thought here was, where do you find, what part of the credit markets do you find most attractive? And there you go, that short duration, higher income. And so fantastic. Thank you. Let's shift here a little bit and talk globally. You also handle global fixed income on the credit side. you know, it's been a strong year too for international fixed income. They've had a solid year. The dollar's tumbled, so there's some opportunity there. But do you believe the strong total returns in international fixed income will continue?
Yeah, we think this is the early part of a trend.
Okay.
So our firm has been allocating more to local currency or foreign currency than we have been in the past because we think that this is a trend that will continue. I think it's partly because of worries about the deficit and inflation and where rates are going in the U.S. The growth stability in global markets, and I think that the foreign currency benefit of being in foreign local currencies, I think is something that is going to continue. So in terms of growth, I still like the US, but I think you get in let's just say in the developed non-US markets, more stable growth. I guess the valuations are better, so less risk of a drawdown, maybe less downside and less upside. And then you overlay that a an attractive foreign currency outlook that should continue to give you a good return profile for some time. So we think that this is the early stage of that trade. It's not the end at all.
Yeah, that's fantastic. And, in Zephyr, I do a lot of research with regarding diversification and correlations, and it just helps add some diversification to your portfolio. But now, helps you with a total return option too. So, a good piece there that I think maybe is underutilized. I think in a
Yes.
lot of
I
portfolios.
think most investors are underweight foreign investment because it hasn't worked for so long. But when it hasn't worked for so long, that means there's a chance it's going to start working again. And now seems like that time where it's starting to work. Just
Yeah.
like gold. Gold didn't work for a long time, and now look at gold. So you can't just look at the historical trends. You have to look at what's happening next.
Yeah.
So I think it's probably a good time for those foreign investment opportunities.
Yeah, I just wrote a piece on diversification. Normalization is going to help diversification. And one of the things about diversification is gives you exposure to asset classes that you typically wouldn't. So you can appreciate like gold,
Yep,
international. Otherwise, you don't get exposure to those and you miss out on because we all know market timing isn't isn't a good strategy.
exactly, exactly.
Lastly, Robert, what does all this mean? We've talked about a lot. What does this all mean for financial advisors as they create investment portfolios for their clients?
I think that you have to take a fresh look at where we are. I mean, markets have been very volatile over really the last several years, and conditions have changed a lot. What I find is that markets are moving faster, and that active management is critical. If you started the year, things were pretty rich across credit and equities, and then we had Liberation Day and everything blew out. That was a great buying opportunity. Now things are tight again. In terms of fixed income, I think active management is critical. Buying the index doesn't work because things are moving too quickly. I think there's an opportunity to, you know, trade volatility, and I think that requires you find a manager who can do it for you because these markets are too fast. And so I think something that DoubleLine offers is that we have experts in all of these markets. That's all we do. So we have people focusing on investment grade credit, high yield, securitized, all the areas, whether it's mortgages, commercial mortgages, ABS, and they're looking at it every day and they're seeing these anomalies that happen. The price anomalies are so short. It might be a week or two, maybe a month if you're lucky. You have to act very quickly. But I do think there's an opportunity for active management. I think people under own, fixed income. People under own foreign investments. And so I think what advisors need to do is take a fresh look and say, what I did last time, what I did over the last few years, that's fine, but I need to look at the world has changed and I need to update what the playbook for 2025 into 2026 is going to be. And, active management, more fixed income. I think that's something that will, you know, really help advisors having that forward look.
Yeah, Robert, I can't agree with you more. I often talk, for a few years now, fixed income's been very exciting, attractive, a fun subject to talk about. But before maybe, during the great financial crisis, even before that, where interest rates were just on a downward decline, fixed income was kind of boring and maybe people forgot about it in the investment. But now you got to invest in it because how attractive it is. You know, the yields are attractive. It's a different time than it was years
Yep.
ago. And I'm really glad you also brought up active management. I've done a lot of research on the equity side. There's some spaces where you can get away with passive management. Markets are efficient, maybe in large core a little bit, but on fixed income, especially when you look at the egg is what, 35% treasuries, you know,
Right.
high concentration there. Fixed income, there's a lot more moving parts, definitely an active management game there.
Exactly. Right.
Robert, thank you so much for coming on the show. I knew it was going to be a fantastic conversation, a real treat to have you on, and you did not disappoint. Where can our audience get more information about Double Line?
I think the easiest place is doubleline.com. All of our content, all of our thought leadership, videos, printed materials, all available there. It's an easy place to go. It's a one-stop location for everything DoubleLine.
Yeah. Fantastic, Robert. Thank you again. It was an honor. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to like and subscribe those channels and follow us on LinkedIn. Thank you and have a great rest of your week.